Hope I can keep that spinning for this whole video. I want to talk to you guys about spousal RSPs today. I didn't write anything, so hopefully this makes sense. I have a little bit of an idea in my head. Spousal RSPs are a good planning tool depending on your situation. Just like almost anything in financial planning, it's very dependent on how your situation looks. This is only going to work, obviously, if you are in a marriage or in a common law relationship. Then you can use spousal RSPs to your benefit. It's generally going to work best when you have one spouse partner that is earning quite a bit more than the other spouse. So they have a way higher income, they're paying higher taxes. So when they put money into their RSP, they're going to get a higher tax refund. Last week I talked about why you're getting the refund that you are. So it should be pretty easy to go back and check that out. So basically, for planning purposes, it's not as important to use a spousal RSP as it used to be, because the government didn't allow us to split our income in retirement. But when you do convert your RSP to a RIF, which is what I'm going to talk about next week, is when to convert to a RIF, which is not an exact date for anybody either. Then you are starting to be able to allow to split that income with your spouse in retirement. So it's not as big of a deal, but there are reasons. Or if you want to start emptying out your RSP before you turn it into a RIF, then you can't split it with your spouse. So it's generally not a bad idea to build up RSPs for each spouse that are similar in size. But you're not going to want to do that if you're in a relationship where you're not both maxing out your RSPs and one spouse is making a whole lot more than the other. So just for example, let's say you were putting in $10,000 a year into your RSP as a couple, and spouse A is paying 45% tax at the highest marginal tax rate that they're at, and spouse B is paying 30.5%. Well, if this person puts $10,000 in, they're going to get a tax refund of $3,050. And if this person puts $10,000 in, they're going to get a tax refund of $4,500. It's a pretty big difference. That's $1,450 extra in tax savings. So what this person could do is say, basically I'm going to put $5,000 into my RSP, and then I'm going to put $5,000 into a spousal RSP for this lower earning spouse. So the entire tax refund of $4,500 in total is going to come to this spouse, but now this spouse has a $5,000 RSP, and so does this one. And so when they're taking them out in retirement or before retirement especially, then it's going to be taxed in this person's hands. I hope that makes sense. This thing's still spinning and I'm pretty excited about that. So what I was going to do was talk about a couple where there's a wife and she makes a ton of money. She makes $280,000 a year and she's just killing it. And she's married to a loser that plays video games and you know, listens to podcasts or whatever about video games and wrestling. But let's say here's a good planning strategy for this couple. Now let's say she could just go right ahead and put all of her RSPs into her own RSP account and max it out and hope that later he gets a pretty good paying job, or even a paying job, and she could lend him money and contribute to his RSP. So you're not going to want to do a spousal RSP if you're going to be more than maxing out one of the RSPs, because it takes the room out of this person's hands. But in this case, let's say for example, she knows that in some time he's potentially going to want to start a business. Or in the other case of the husband making a lot of money, they know that they want to start a family in a few years. So what they can do is contribute a lot of money into a spousal RSP to get the good tax refund at the time. So in her case, if she put $10,000 in, she's going to get a 48% tax refund in Alberta, which is great. Now it's in his hands, but he can't immediately take that out. That money has to be in there for 3 years. But let's say in 3 years' time or further out, he decides that he wants to start a business and he has no income on paper. Well, now what he can do is pull all of that money out of his RSP and use it to fund his business. So she's basically got the tax refund to give him some money there. And it can work the other way. But remember, the money has to be in there for at least 3 years. And another big caveat on that is that if she put $10,000 in each year, that doesn't mean that 3 years later he can take out $10,000 like from the first year. It's 3 years from the last contribution. So that's something to keep in mind. Other than that, I mean, I generally think it's a pretty good idea to just set it up so that each one of the couples in the relationship has similar size RSPs. That way it makes tax planning easier come retirement time. The government could change rules about income splitting in retirement, so there's another good reason for that. And always using it to maximize what your return or refund is going to be based on that, instead of having, you know, this guy put 10,000 in and get 25% and her put 10,000 in and get 48%. Well, that makes no sense. You've lost out on a substantial bunch of money. So if you have questions about if they work for you, as always, you can contact us anytime. info@k4financial.ca. And if you haven't already, please subscribe, comment, and we'll see you soon. Thanks.